So, Gordon, let's drill down into those three stakeholder groups one by one, starting with the business itself and the people that are really central to that business. So, if you've got fellow directors, key employees, in those early stages of running a business, you're pretty dependent on each other, aren't you? You're often carrying complementary skill sets that may be very credible to the people that you want to sell to or get to invest in you, for example, even to attract other people like you into that business. That carries substantial risk, doesn't it, if one of you suddenly isn't available?
It does, because what you've got is an overexposure in the early stages to a couple of key individuals. And if those individuals aren't about, they can have a massive impact. It could be the sales coming into the business because it's the top sales guy. It could be the banks if they've lent you money. They may be worried about your ability to pay it back. It could be your suppliers who now don't wish to give you credit anymore because one of your key people is about. And it's often driven by the cash flow. We've seen scenarios before where this has happened to new businesses. It's the cash flow which does for them in those circumstances. So it's trying to identify what the risk is for each individual in the business, identify who these key people are, and making sure you can try and protect against their loss.
Yeah, and it's also about making sure that whatever you put in place projects that sort of external position outwardly, and so that other people can have confidence in that. So investors are confident, so that your rock star talent that you want to come in and join you is really confident in that. So it's as much about putting that foundation in place to be able to speak to others as it is actually to protect the business in the event of one of you suddenly not being there.
Yeah, I think it gives everybody a lot of security to know that the whole business is not dependent on one individual's success or one individual still being about. So I think it's a really good tool, particularly for outside investors or lenders, to have these plans in place, the structure in place before you go and seek more funding, before you try and borrow more money further down the line.
I mean, for a lot of businesses, particularly when they're first starting out, one or two individuals really will be key, won't they? And that's just unavoidable.
Yes.
How do you smooth out those risks? What are your options?
There's two options, really. One is hold on to an awful lot of cash, which for which for a new business is highly unlikely. So you can't really have a large cash buffer in the event one of the key directors may not be there. Or the second and the easier option is to look at a relatively cheap life insurance policy on that particular individual that simply gives the business cash when it needs it most.
Yeah, and would you do the same with critical illness as well? So they might not die, but they might suddenly become seriously incapacitated, and that would have the same impact.
Well, we do have discussions actually with clients where we suggest that actually dying's better than being critically ill, because at least when you die, you're not on the books anymore. You're critically ill, you're on the books anymore. So it's just as important that the serious long-term illness is covered off as well, because statistically, that's more likely to happen.
Yeah.
And it actually costs more because of that.
Absolutely. And really you want either the insurance payout or the cash, that if you're lucky enough to have that surplus cash hanging around, you want that to be able to rapidly recruit somebody else, even if that's somebody to stand in as an interim or it's somebody to come in permanently. It's the recruitment fees that are often associated with that process. It's not just salaries you need to be thinking about there. So it can be a massive drain, can't it, if you're suddenly a key person down very early on?
It can be. It has so many elements about extra cost and recruitment, as you say. Cash flow is the big one. Suppliers and credit facilities can often dry up. Our lenders can ask for repayments of loans and credit facilities as well. So we tend to think a large chunk of cash coming back in is the best way to steady the ship in those circumstances.
Yeah, absolutely. I mean, we had a situation recently where there was a very established startup business who lost their key person on sales and relationships, and that was one of the co-founders. When that person disappears, a lot of the relationship, a lot of the stability of that business suddenly, there's a big gap, and they had to pay an awful lot of money to get somebody who could fill that gap really quickly with the same kinds of contacts. And of course that person knows that they're really needed, so they're almost coming in commanding their own price,
charging a premium.
Precisely, and they did.
And
I think you don't have that option if you really do want to keep the wheels on the cart and everybody happy and the money still flowing in, etc. So having some kind of fallback mechanism or contingency plan, insurance probably sounds like it's more likely to be the option for most of us, is absolutely vital.
It's the avoidable, easier option for new businesses setting up.